Good morning, everybody, and happy Monday. Got a big week ahead here, and we'll get started in just a couple of moments. I want to make sure the stream is working here and up and running and everything. All right. Okay. Let's get started here. Good morning, everybody. Happy Monday. Big week ahead, as I just mentioned, in terms of data, both economic data, corporate data, and of course, as a result, we'll have to see what the market wants to react like. We continue to see, more deterioration as far as equities are concerned underneath the surface. So, tying this into the year of the trader, we think it's going to be super, super important to be able to invest and trade in assets that are not just, your 5, 6, 7, 8, 9, 10 favorite stocks that have worked so well for the past years. So that's why we think a lot of people are going to do very poorly this year. People that are just chart chasing a few headline stocks. So make sure you expand beyond those stocks and into different asset classes as well. That's why ETFs are such a great way of doing that, which some people find boring, but those boring can really make money over time. So let's look at a couple of things here that are top of mind. Again, first of all, just if you're new here, welcome. I'm Serge Berger from The Steady Trader. Please make sure you subscribe and you hit the like button. Top 3 things here for the next 10 minutes or so to get the week started. First of all, again, big week economic data wise. We've got the PPI report tomorrow, and then we've got more inflation data down the week. And then on Wednesday really, and then on Wednesday also we get more corporate earnings. The banks start kicking off, Goldman, JP Morgan report earnings. So that's important. And it's all happening at a time when some stocks, or the big stocks that I just mentioned, are starting to look a little bit more wobbly. Just for example, and I posted this in the Inner Circle chat room over the weekend, as well as into, I believe I also posted it into YouTube community. So if you subscribe to the channel, which you should, go into the communities, you should see that chart there. This is the 2-year chart on Microsoft, and you can see we're sort of at the lower end of this arch, and only time will tell. Earnings late this month, I should say, late January. But this will be interesting to see how this holds. My gut feel is that ultimately we do break below this. Apple doesn't look a heck of a lot different either. So, those are the big stocks that everyone focuses. And so if I look at last week's price action, number 2, it was really all about yields going higher. So our inflation expectation is actually breaking out. Again, I know this is not something that people that chase headline stocks see, but it moves the market. As I been saying now for the past couple of weeks, the equity market can't break the stock market, but it can't break the bond market, or the commodity market, but the bond market can break the stock market. And so you want to keep that in mind. That's why it's so important to, that's why we like to watch so closely what these big picture developments are in terms of growth, inflation, yields, all the kind of stuff that ultimately does matter. I know people haven't thought it mattered for a while, and it hasn't as much. That is certainly true. At some point, it does matter. So inflation expectations are breaking out, and as a result of that, we continue to see bond prices go lower. So what you're looking at here in red at the bottom, or purple, whatever you want to call this color, is bond prices going lower. So TLT going lower, bond yields going up. And so you can see that the blue line, which is the S&P 500, hasn't really cared, but typically speaking, it tends to catch up with bond yields if bond yields spook the equity market enough. So this is what's happening right now, and we do think there is a potential that equities correct more from here. It's been, I think, about just north of 20 days of sideways action in the S&P 500. And again, that's why I started off with Microsoft and Apple. They all are, holding on here, but on thinning support. So you want to watch for that. Also, this is also a really, really important chart. I've been showing this one as much as I can everywhere. This is gold, which this morning gold futures are down 1%, but the bull trend in gold remains intact. The question is more, what's the near term? And near term, we saw it on Friday. Gold had a big rally. Again, this morning, gold futures are pulling back. But I think what's more important here to notice is that gold, which is the blue line at the top, if you look at it over the past few years, it's completely disconnecting from volatility, equity volatility. So the VIX, which is red down here, and this is notable because typically speaking, while the gold and the VIX, it's more of a near-term positive relationship. Long-term, they can disconnect, but gold is still making a really, really big move with very little equity volatility. So to me, it just speaks to a lot of complacency in the equity market. Again, we're not calling for market crashes. We think this is going to be a year of the trader, but people that are very heavy in S&P 500 only, and that's for what holds true, unfortunately, for most people, are going to have a very difficult time this year unless they look elsewhere and learn elsewhere to make money. And that typically isn't something that one learns in a day. That takes some time and experience. And so we would hope everyone starts learning that ASAP here and getting on that path. So it's all the same thing that's happening. Bond yields going up, i.e. bond prices going down. The red chart on your screen, the S&P is starting to wobble a little bit. Wednesday is going to be an important day. Gold is up, despite the dollar up, which is the bottom chart, which is unusual, right? With the dollar having such a big move, it's unusual for gold to be up this well. And again, gold up despite very little equity volatility, although the VIX is back above 20 as of last Friday's close. And then last but not least on this big picture stuff, is this, before we look at the two more charts, this is probably one of the more important charts that I can share with anyone. What we're looking at here is the relationship of tech stocks versus commodities. So what I did is I took the QQQ ETF and divided by DJP. And what you're getting here is this is a long-term weekly chart. And you can see that obviously tech stocks have dramatically outperformed commodities. And we think over time, over the long run, that could happen again. But we're probably at a point where it's going to mean revert. And even just in 2022, which was not a long-lived situation, this ratio collapsed by 50%, meaning tech stocks dramatically underperformed commodities in 2022. And we think now, this is literally last week's break of support of the 2023-24 trend line. This could lead into a much bigger thing down the road. Like this could lead to a 5-year underperformance. Possibly. So I would watch this very, very closely. So all these things that I'm trying to show you here this morning are pointing towards the same thing, which is that higher yields are putting some pressure on the high beta tech stocks, at least for right now, and we're seeing allocation into things like commodities, anything that's going to do better in higher inflation. So we'll have to see how the inflation story plays out. Again, Wednesday is going to be an important tell. Two more things that I'd like to share with you, particularly one more thing I want to share with you. Insurance stocks, the IAK ETF, which we actually have, the market rover has now turned this into neutral trend. So it's no longer a bullish trend, it's gone into neutral. That is notable. And of course, insurance stocks coming off, this to some extent has to do with the horrific fires in California. And I would just be mindful of this, because it does look to me like ultimately this will, once it bounces, will lead to more of a lower high than an immediately new high. In fact, the Dow looks very, very similar to us. If you look at the DIA ETF, which we think is now may have put in its highs, and any other next rally will be more leading to lower highs. So those are some things that we are watching. If you guys have any questions, let me know right here, right now, to kick off the week. But those are the things that are top of mind on our charts, if you will. So want to start the week here slowly. Again, it's going to get very, very active by Wednesday, and just heed these signals. And like I keep saying, obviously I can't give you investment advice here, but through the lens of education, we've been saying this now for multiple quarters. Make sure we have a diversified portfolio from a long-term perspective, and from a trading perspective, which I know a lot of people are still only trading. It's going to be a trader's year, but your portfolio can't be neglected, because that's typically the majority of the money for a lot of people. But from a trading perspective, be open-minded to other things than the tech names, and that it could really make or break a year this year for a lot of investors and traders. So that's it for now to start off the week. Short and sweet, 10 minutes or so. Again, please make sure you subscribe to our channel so you get updated in real time when we go live. We're going to go live a lot this year, not only in the Set the Market show, but also when important things happen and important market things. We go live and give you live updates here as well. And give us a thumbs up, like. Thanks for listening. See you guys back here tomorrow morning. Set the Market, 9 o'clock Eastern.